Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. Risk disclaimer. True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elliott Wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott Wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the Consumer Price Index CPI related to United Kingdom, and I'm going to discuss the GBPUSD currency pair. Next one is the German flash manufacturing PMI related to Eurozone, and I'm going to discuss the euro dollar currency pair. So let's get started. The first one is the Consumer Price Index CPI, United Kingdom. What is the Consumer Price Index, also known as CPI? The United Kingdom's Consumer Price Index CPI measures the annual change in prices for a broad basket of goods and services and serves as the primary gauge of inflation. It reflects changes in the cost of living and overall purchasing power within the economy and is released monthly by the Office for National Statistics. The Bank of England (BOE) closely tracks CPI trends when determining its interest rate policy. A higher CPI reading indicates rising inflationary pressure, increasing the likelihood of tighter monetary policy and potentially strengthening the British pound. Conversely, a lower CPI suggests easing inflation, reducing the urgency for further rate hikes, and can weaken the British pound. Now, the financial news event that we got is on October 22nd at 6 a.m. UTC time. The previous number was 3.8%, forecast was 4.0%, and the actual number we got is 3.8%. The currency pair we focus is the GBP USD currency pair. Attention now shifts to the European session where the UK Consumer Price Index CPI data for September has just been released. The headline reading came in unchanged at 3.8%, missing expectation for a modest uptick to 4.0%. So Forex traders were expecting a 4.0% number, and we got an actual number as 3.8%. This softer than forecast results suggest that inflationary pressures are not reaccelerating as some analysts feared, reinforcing the narrative that the Bank of England may remain cautious and keep rates on hold for longer. The market reaction was immediate. The British pound slipped against the US dollar as traders priced in a reduced likelihood of further tightening from the Bank of England. Let me show you the chart of GBPUSD currency pair. This is the daily time frame of GBPUSD currency pair. So right over here on 22nd October, we got this news announcement and price action dropped overall inside GBPUSD currency pair. The Bank of England Balancing Act and the inflation that we got, it's still above the target, but it's kind of cooling down. The latest CPI report confirms that headline inflation remains well above the Bank of England's 2% target, but crucially, it failed to rise as expected. This signals that price growth is stabilizing, easing pressure on the central bank to maintain an aggressive stance. While inflation has not yet returned to comfort levels, the absence of renewed upward momentum gives policymakers room to adopt a wait and see approach, especially aimed slowing growth and softening wage data in UK. Preliminary details from the Consumer Price Index report suggests that the core CPI and services inflation, both key indicators of domestic price persistence, have shown tentative signs of easing. This reinforces the view that earlier rate hikes are gradually filtering through the financial economy, curbing demand and moderating price growth. Forex market participants now anticipate that the Bank of England next move is more likely to be an interest rate cut in early 2026, bearing any renewed inflation shocks. So the impact we got on the GBPUSD, which I just showed you, is we got the drop over here inside pound dollar currency pair. The move lower reflects a shift in sentiment towards a more dovish Bank of England outlook with rate cut expectations gaining traction. Short-term UK yields fell while US dollar demand strengthened amid safe haven buying and relatively firmer USA inflation dynamics. The next one is the German flash manufacturing PMI report. So, what is the German flash manufacturing PMI? The German flash manufacturing PMI, or also known as Purchasing Managers Index, measures the performance of Germany's manufacturing sector based on monthly surveys of purchasing managers across key industries. It tracks changes in output, new orders, employment, supply delivery times, and inventories. A reading above 50 indicates expansion, while a reading below 50 signals contraction. Since Germany is the largest economy in the Eurozone, this financial indicator serves as an early gauge of regional economic momentum. Stronger PMI readings generally signal industrial growth and business confidence supporting the euro, whereas weaker figure reflects slowing demand and can pressure the euro dollar currency pair lower. So we got this German flash manufacturing PMI data report. The previous number was 49.5. The forecast was 49.5 and the actual number we got is 49.6. So during the European session, Forex traders focused on Germany's flash manufacturing PMI, and it's a key financial indicator of industrial health across the Eurozone's largest economy. The financial data showed a slightly stronger than expected reading of 49.6, just above both the forecast and the previous month's figures of 49.5. While the index remains marginally below the 50 number, which is a threshold number, still technically in contraction territory. The steady upward momentum suggests that the German manufacturing sector is edging closer to stabilization. Following the release, the euro strengthened modestly with euro USD moving higher as markets interpreted the data as a sign of resilient industrial activity and potential improvement in overall eurozone sentiment. Let me show you the chart of euro dollar currency pair. Here is the chart of euro USD currency pair. Okay, and right over here on 24th October 24th. Let me try to delete this line. So over here we got a bullish rally inside euro dollar currency pair overall on October 24th after the financial news event. So the data showed a slightly stronger than expected reading of 49.6, just above both the forecast and the previous month's figure of 49.5, while the index remains marginally below the 50 threshold. Still technically in contraction territory, the steady upward momentum suggests that the German manufacturing sector is edging closer to stabilization. Following the financial data release, the euro strengthened modestly with euro USD moving higher as forex markets interpreted the data as a sign of resilience, industrial activity, and potential improvement in overall eurozone sentiment. So the October data signals a tentative recovery in Germany's manufacturing sector after months of stagnation. Although the PMI remains fractionally below 50, the small upside surprise reinforces the view that industrial conditions are improving at the margin. The gains in output and new orders contributed to the headline figure, suggesting that demand is stabilizing after an extended downturn. At the same time, cost pressures have eased and supply chain conditions continue to normalize, pointing to be a more balanced manufacturing outlook heading into quarterly 4 2025. The ECB policy outlook is a stable shift towards neutrality. The slightly better than expected PMI adds nuance to the European Central Bank, the ECB policy stance. While inflation concerns remain recent, economic softness had increased market expectations for early 2026 rate cuts. So the PMI reading that we got, however, tempers those expectations slightly, suggesting that the Eurozone economy may not be as weak as feared. This reduces pressure on the ECB to move aggressively towards policy easing, lending near term support to the euro. So the market reaction we got is the euro USD currency pair actually moved up. The euro gained modestly following the release as investor interpreted the PMI beat as a sign of stabilization in the manufacturing sector. Now, if you look at the number, it's still below 50 number. So 49.6 is still less than 50. So the overall data reduced downside risk for the euro with markets pricing in a more balanced ECB trajectory. Now let us take a look at previous week global market trends, and I'm going to take a look at euro dollar and US dollar Swiss franc currency pair. Here is the chart of euro USD currency pair, and If I zoom out a little bit, we got this trend line break and then a retest. Market is probably trying to move sideways, and the way I see the price action of euro dollar is probably going to drop one more time. Then we have this support over here, down over here, which market still needs to clear. So to me, the trend is up, but on a short-term basis, if you take a look at a 4-hour time frame, the trend is still down inside 4-hour chart of euro versus United States dollar currency pair. Okay. Next one is the US dollar Swiss franc. The US dollar Swiss franc weekly trend is down. If you take a look at daily time frame, we got this bullish breakout and now market is trying to rise back up over here. Here's the 4-hour chart. You can see price is showing some signs of bullish momentum over here. Now let us talk about the current week's macroeconomic events and financial data releases. I will be covering the key developments in the forex market with a focus on fundamental analysis. The first one is the consumer price index, Q over Q. This means quarterly report related to Australia, and I'm going to focus the Australian dollar currency pair, AUDUSD currency pair. Okay. So, what is the consumer price index, CPI? The Australian Consumer Price Index, also known as CPI. CPI is just a short name, it's an abbreviation, and it measures the quarterly change in prices of a broad basket of goods and services. It's one of the most important financial indicators of inflation and directly influences the Reserve Bank of Australia's monetary policy decisions. A higher CPI reading typically signals that inflation is rising, which may push the RBA towards raising interest rates, a move that often strengthens the Australian dollar. Conversely, a lower CPI suggests cooling inflation, which can increase the chances of future rate cuts and put down pressure on the Australian dollar. In short, the CPI gives investors and policymakers a snapshot of consumer purchasing power and helps shape expectations for Australia's economic outlook. So, on October 29th at 12:30 a.m. UTC time, we're going to get the report. Let me tell you the previous number we got. The previous number was 0.7%. The forecast is 1.1%. The actual data not yet released. And our currency pair that we're going to talk about is the AUD USD currency pair. Up next, all eyes on Australia's quarterly consumer price index due at 12:30 a.m. UTC time. This is a key data point for traders watching the Australian dollar as it provides the latest insight into inflation trends across the economy. Markets are expecting a stronger print this quarter, with forecasts calling for a 1.1% increase compared to 0.7% previously. If the financial data confirms higher inflation, it could bolster expectations of tighter policy from the Reserve Bank of Australia, potentially giving the Aussie dollar a lift against the US dollar. However, if inflation surprises to the downside, it may raise speculation about a pause or even a future rate cut, leading to weakness in AUD USD currency pair. The RBA has been walking a fine line between controlling inflation and supporting economic growth. Recent commentary from policymakers suggests they remain cautious about but data dependent. A higher CPI reading above the 1.1% forecast would signal that price pressures remain persistent, reinforcing the argument for a longer period of elevated interest rates. That would likely strengthen the Australian dollar as traders price in a more hawkish Reserve Bank of Australia's stance. On the other hand, if CPI comes in softer than expected, say below 0.9%, it could suggest that inflationary momentum is fading, increasing the likelihood of a dovish shift from the central bank. This scenario would typically weigh on the AUD USD currency pair. So let me discuss potential market reactions and or scenarios. So if the CPI is higher than 1.1%, a stronger reading would likely boost the Aussie dollar, and it would imply that inflation is heating up again. So forex market could translate this as a sign this Reserve Bank of Australia may need to tighten further or delay rate cuts, supporting the AUD/USD to the upside. And if the CPI is in line with the forecast is 1.1%. So if you get the same number on October 29, 1.1% number, then the chances are AUD/USD currency pair is probably going to move sideways. Now, if the CPI is lower than expected, meaning less than 0.9%, a weaker CPI print would likely be bearish for the AUD USD currency pair, as it would reinforce expectations that the Reserve Bank of Australia's next move could be an interest rate cut. So, forex traders might respond by selling the AUD USD, especially if the US data remains firm and support the US dollar. So the upcoming CPI report is one of the most closely watched releases for the Australian economy this quarter. With inflation still above target but trending lower, the balance of risk remains delicate. The Reserve Bank of Australia has made it clear it wants convincing evidence that inflation is sustainably moving back towards its 2 to 3% target range before shifting its stance. As such, even a slightly stronger CPI data could extend the Reserve Bank of Australia's current tightening bias, while a weaker number would strengthen the case for policy easing in the year 2026. Next one is the GDP related to Canada. So, what is gross domestic product, also known as GDP? The gross domestic product or GDP measures the total value of all goods and services produced in Canada over a specific period. It's the most comprehensive indicator of economic activity and growth. A stronger than expected GDP reading suggests that the Canadian economy is expanding faster than anticipated. This could increase the likelihood of interest rate hikes by the Bank of Canada and typically strengthens the Canadian dollar. On the other hand, weaker GDP data signals slower growth and could prompt the Bank of Canada to adopt a more dovish stance, potentially weighing on the CAD. Overall, GDP plays a crucial role in shaping forex market sentiment, monetary policy expectations, and the direction of the USDCAD currency pair. The event name is Gross Domestic Product related to Canada, and we will get the actual report on October 31st at 12:30 p.m. UTC time. The previous number we got was 0.2% number. The forecast is 0.0%. The actual data not yet released. Coming up next, we have Canada's latest GDP figures set to be released at 12:30 p.m. UTC time. This financial report will give us a fresh look at how Canada's economy performed in the most recent months. Forex markets are expecting flat growth at 0.0% following a 0.2% expansion in the previous period. Given the recent economic slowdown and softer domestic demand, investors are watching closely to see if growth has stalled or if there is still enough momentum to keep the Bank of Canada on hold for a while longer. The USD CAD pair could see some sharp moves depending on how the data compares to the forecast. The Canadian economy has faced mixed signals in recent months. On one hand, consumer spending and exports have shown resilience, but housing activity and manufacturing remain under pressure due to high interest rates. The Bank of Canada has paused its tightening cycle but remains cautious, waiting for clear evidence that inflation is moving substantially towards its 2% target. A stronger GDP reading above the forecast of 0.0% would indicate that the economy is holding up well despite higher borrowing costs that could lead forex markets to believe the Bank of Canada will stay hawkish for longer, pushing the Canadian dollar higher. However, if GDP turns negative, suggesting contraction or stagnation, it could raise expectations of future rate cuts, which would weaken the CAD and potentially drives USD CAD currency pair to the upside. So the potential market scenario is if the GDP number is higher than expected, meaning greater than 0.2%, then it means a stronger GDP number would likely boost the Canadian dollar as it would show that economic growth remains resilient. Forex traders might translate this as a sign the Bank of Canada could delay any rate cuts, leading to downside pressure on the USD CAD currency pair. Now, if the GDP number matches the 0.0% forecast, then it means a flat reading would suggest the economy is losing momentum but not yet contracting. This could result in a muted market reaction as it confirms expectations of a steady but fragile growth environment. So, USD CAD may remain range bound. Okay, and let's say the GDP number we get is weaker than expected, meaning goes into a minus 0.1% number. So the negative reading would likely be bearish for the Canadian dollar, signaling that growth is slipping. Markets may then anticipate earlier or deeper rate cuts from the Bank of Canada, pushing the USD CAD higher as investors seek safety in the US dollar. So the conclusion is traders should watch for volatility around the financial data release at 12:30 p.m. UTC time on October 31st when the GDP data comes out. Keep in mind the market will also interpret the report in the context of inflation trends and Bank of Canada's policy expectations. A surprise in either direction could quickly shift sentiment on the Canadian dollar. Next, let us take a look at global market trends for the current week, and I'm going to take a look at euro dollar and Australian dollar currency pair. So the first one is the euro USD currency pair. The way I see market is trying to rise up over here. This was a retest of this trend line, a broken trend line, I would say. And let me change the color of this arrow to blue. So we got a retest right over here, and then market tried to drop a little bit. It's trying to move sideways in euro dollar currency pair. The way I see price action is probably going to drop more before it goes back up. So ideally speaking, we are probably going to see a bearish breakdown in price action below 1.1541 area inside euro dollar currency pair. Next one is the AUD USD currency pair. The trend is down overall inside AUD USD currency pair. If you take a look at a daily time frame, this is where we got the bullish breakout. And then in 4-hour chart, here's another one. Price actually opened with a gap over here. Okay. Next one is the USD CAD currency pair. Okay, this is the USD CAD currency pair. Let me zoom out a little bit. The way I see, we got this nice uptrend over here inside US dollar versus Canadian dollar currency pair. However, price action, is still below this old swing high, and the way I see this looks like to me, we got this nice bullish trend channel, but the price action is falling down. So it's quite possible that USD CAD is probably going to drop around the lower trend channel line before it goes back up. Next one is the XAU USD pair spot gold. Let's take a look at gold. Gold, I told you guys that market is going to print a top over here. This is quite an extended move that we got, and the way market was moving up swiftly, The same thing happened to the downside. Now the price action is falling down. This is where we got a uh, breakdown of this bullish trend line. So my forecast is bearish for the spot gold. The way I see USD the XAUUSD pair, the spot gold is probably going to drop more in coming trading days. Okay, if you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So let us review what we have learned today. We discussed about the consumer price index CPI related to Australia, and we also discussed about the gross domestic product GDP related to Canada. And we also take a look at price charts of euro dollar, AUDUSD currency pair, USDCAD, and spot gold. These are the assets to watch out for profits. What you should do next? Well, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. If you want to learn more about Forex trading, visit TradeGeek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, November 4th, 2025 at 12 p.m. UTC time. So that's it for the time being from my side. Have a nice day and bye bye.